Let's get more reaction to Tesla's quarter with Fast Money friend and Loop Ventures founder Gene Munster. Gene, you've heard the panel. We know it's a good quarter. Tell me why Tesla should be valued where it is.
Well, today it shouldn't. I think that the panel appropriately outlined the valuation concern. I share some of that valuation concern. I do believe that ultimately this can be a much bigger company. And if you look at a 6.5 multiple for a hardware services and Apple type multiple on this, today off the revenue, it suggests it should be worth $450 billion. But if you take their guidance today for 50% growth, and I think this is an important piece to the conversation, and you go 2 years forward on that, you have $1 trillion company. And so to answer your question, I think that this is the definition of a growth stock that needs to ultimately, that's probably a year ahead of itself. But ultimately, I think it's going to get there. And I would just point out a couple quick data points here, is that the growth in the quarter, 122% delivery growth off of an easy comp a year ago. The auto industry grew at 55%. So, of course, competition's coming, but they seem to be bucking the trend. Separately on this margin, and Tim's point about the profitability, I absolutely agree. This company needs to prove that it is a tech-like margin business. The margins this quarter, ex credits, as Phil mentioned, was 25.8%. Last quarter was 22%. They did that despite ASPs being down 2% and a higher component pricing environment. And so I think what you're seeing is they're not there yet. This requires investors to look beyond the current year. But if you take the trends that they're having in margins and the demand piece and put those together, I think you can build a case that this can be a much bigger company, albeit a bumpy ride there.
So I think that point is really key, Gene. The part about they expect 50% average annual growth in vehicle deliveries over a multi-year horizon. That is a growth multiple. So basically, you think just the margins have to catch up, and then you can back into the multiple they have today.
Well, they need to continue to grow, so they have to deliver on that. They're doing that this year. But ultimately, if they can do that for a couple of years and keep margins where they're at, I think that investors will start to get comfortable. And this is the beautiful thing about Tesla and having an opinion on it is one camp, very smart camp, says competition is going to erode. Another camp, the camp that I'm in, says this is a large market and they can lose market share but continue to grow at 50%. And I think that the stock will be rewarded for that.
What's your number one question for, if you could ask Elon Musk a question on the call, what would that be?
So they just started selling FSD as that's the full self-driving as a subscription, and it puzzles me that why they still market it as full self-driving. And I would just ask that is that it does a lot of things. It's better than any other car manufacturer, but I think that they need to kind of tighten some of the language around that for marketing purposes, and then allow consumers to kind of get behind it for the stage that it's at today. We're still a few years away from autonomy, despite the language they have around FSD. And that subscription piece, just one final thought there, the reason why I start there is the top question, is that it has a massive, highly profitable revenue, and eventually 10 years from now, all cars will be full self-driving. And they talk about margin expansion. They can get there in a hurry if they expand with this subscription service.
Hey, Gene, it's Tim. So FSD, yeah, maybe at some point, very high margin business. That could be a big part of the business. But what we're really talking about, and even Melissa alluded to the 50% growth, at least in terms of units. And then we talked about that the essentially the profitability of the core business is not that of a tech company, but we're still talking about an auto company. Even what you're talking about, how about the stuff that's been applied to this story for a long time around either some of the data, some of the technology, and obviously the battery? That's the part that to me is where the bulls have really fallen back on all the time and said it's not really an auto company. So can you talk about that? Because all we're talking about today are the margins of an auto company.
Well, first, they have to continue to show these margins and move them from 25, 26% into the mid-30s, mid-40s over time. So to answer your question, I still think auto is a big piece to it. And there are other pieces to it. You could talk about what they're doing in energy capture and energy storage and potentially robo-taxi. There's these different things that you can bolt onto. But I'm just, at least today, I'm taking a step back and just saying, let's just focus on that auto business. And you bring a good point that, should we give them credit for being a tech company? And the answer is today, no. But if they keep doing what they're doing right now, a year, 2 years from now, I think that more investors will, and that will move the multiple and the stock higher.
All right, Gene, maybe we'll see you a little bit later on. Thanks so much, Gene Munster.
Shepard Smith here. Thanks for watching CNBC on YouTube.